Welcome back to Iron Financial. This is the place where we forge stronger portfolios by cutting right through the market's noise and weakness. Today, we're putting on our hard hats. We're grabbing the blueprints for an industrial titan that is sitting at the absolute epicenter of the energy transition, and you guessed it, the AI revolution. We're talking about GE Vernova. They just dropped what looks like a monster earnings report, but the market's reaction? Well, it's created a battlefield for the bulls and the bears. So we're here to inspect the foundation, check the load-bearing walls, and see if this thing is built on solid rock or shifting sand. Let's get to work.
Okay, let's just get right into the thick of it, because the headline numbers on this thing are absolutely staggering. I mean, GE Vernova didn't just beat earnings expectations, they completely obliterated them. We are talking about an earnings per share surprise of over 315%. 315. I mean, come on, numbers like that should send a stock straight to the moon, no questions asked. But hang on a second, you're telling me they hit a grand slam, a walk-off bottom of the ninth home run, and the crowd booed? That makes absolutely no sense. The stock didn't soar, it stumbled, dropping 3.3%. Now, a dip like that on a report this strong isn't just a few investors taking profits off the table. No, that's a vote of no confidence. It means the market is sniffing out a problem somewhere. And that right there is the paradox we have to deconstruct. Is this a sign of some hidden weakness, a crack in the armor, or is this a massive buying opportunity that the market is foolishly handing you on a silver platter?
That's exactly right. So here's our inspection plan, our blueprint for today. First, we're going to tackle that perfect report paradox, really break down the blockbuster numbers that are causing all this confusion. Then, we're going to examine the steel beams of this company. We're talking its core power segment. After that, we'll fire up what's supposed to be the growth engine, the electrification business, and really look at its connection to this AI supercycle everyone's talking about. But then, and this is important, we have to address the crack in the foundation. We have to talk about the persistent, nagging wind problem. And finally, after all that, we'll deliver our verdict. We're going to try and answer the ultimate question. For an investor looking at this stock right now, is GE Vernova a golden opportunity, or is it a carefully laid trap?
All right, let's get into the guts of this report, because when these numbers first hit the wire, I mean, they looked absolutely flawless on the surface. We're going to put these figures on the table and show you precisely why the initial reaction from so many Wall Street analysts was just pure shock and awe. And more importantly, why the market's decision to sell it off is so confusing. Okay, look at this table. What's really wild here is just the sheer magnitude of the beat. Wall Street, right, the so-called experts, they were looking for earnings per share of around $3.22. GE Vernova came in and printed $13.39. That's not a beat, that's not an outperformance, that is a different stratosphere. But hold on, let's pump the brakes a little bit. $13 a share? Even for a massive beat, that number feels absurd. How much of that is just some one-off accounting gimmick? I'm looking at the fine print here and I see a nearly $3 billion tax benefit. That's not operational excellence, that's just a really good trip to the accountant's office. Now, that's a fair challenge, and it's a good point. And yes, you're right, that tax benefit is a huge piece of that headline EPS number. But you can't just dismiss the operational strength that's sitting right underneath it. Just look at the top line, revenue. They came in at $11 billion, absolutely smashing the $10.2 billion forecast. This wasn't just an accounting trick. The core business, the part that actually builds stuff, is humming.
And if you want to know just how strong that core business is, you don't have to look any further than this number right here, $150 billion. That is their total order backlog. That's their book of future business, signed, sealed, and delivered. And it's up a staggering 26% from this time last year. This isn't some theoretical demand or a pie-in-the-sky projection. These are signed contracts. This number provides years and years of revenue visibility. In a world drowning in economic uncertainty, having a backlog of this size is like having a financial fortress. It tells you that the demand for what they build isn't just strong, it's actually accelerating.
And this number right here, this just brilliantly illustrates the health of the entire operation. $3.7 billion in free cash flow for the full year. That is more than double what they generated in 2024. You know, this is the lifeblood of any company. This isn't just paper profit or some accounting entry. This is hard cash. The cold, hard cash they can use to invest in new tech, pay out dividends, and buy back their own stock. Doubling your free cash flow in a single year is a massive signal of operational excellence and really disciplined management. So you see, everything on paper looks like an absolute home run.
Okay, analyst, you've laid out a beautiful case. I get it. A massive earnings beat, a fortress of a backlog, a fire hose of free cash flow. So I have to ask the question that I know everyone watching is thinking right now. If the foundation of this company is made of solid granite, why did the stock trade like the market just found a major structural flaw? A 3.3% drop on this kind of news is not just profit-taking. It's a signal of doubt. It tells me that for all the incredible strength you've just shown me, the market is laser-focused on something else, something that it really, really doesn't like. So what are we missing here? What are they so afraid of?
That is exactly the right question to be asking. And to answer it, we have to inspect this company piece by piece. So let's start with the core, the load-bearing steel beams that hold up the entire structure, the power segment. This division is the historical heart of GE. And right now, believe me, it is not just some sleepy legacy business. It's an absolute cash cow, and it's enjoying a massive renaissance.
Let's be crystal clear about what we're looking at here. This isn't your grandfather's old, dusty power plant. The power segment is built around cutting-edge technology like their H-class gas turbine. This machine is the most efficient, heavy-duty turbine on the entire planet. And in a world that is screaming for energy to power data centers 24/7, these machines are the answer. They provide that reliable, baseload power that intermittent renewables like solar and wind simply cannot guarantee. And what's more, they're future-proofing this technology by adapting it to run on hydrogen blends. So this is a high-tech, high-margin business that is absolutely essential for grid stability today and tomorrow. And the momentum here, it's just undeniable. Let's break this down line by line. First, just look at the gas power backlog. Sequentially, just in a single quarter, it jumped from 62 gigawatts under contract to 83 gigawatts. That is a massive leap in demand, and it's being driven by huge orders in the US and, crucially, direct deals with data center operators. On top of that, look at the services backlog. Now, this is the really good stuff. The high-margin, recurring revenue from long-term service agreements. It grew by $10 billion. That's the bedrock of their profitability. And it all leads to this final point. Management is guiding for 16 to 18% organic revenue growth in this segment for 2026. This is the engine room of the company, and it is running at full throttle.
So, okay, the power segment is that rock-solid foundation, and it's just pumping out cash. But every great industrial titan needs a growth engine. So now let's look at the skyscraper they're building on top of that foundation, the electrification segment. If power is the reliable cash cow, then electrification is the thoroughbred growth engine, and it's perfectly positioned to capitalize on one of the biggest market trends of our entire lifetime.
All right, hold on a second. AI-powered supercycle. I hear that term everywhere these days. It feels like the new buzzword that every CEO in America is using to pump their stock. Is this a real durable trend, or is it just market hype? Break it down for me. What does it actually mean, and why is GE Vernova supposedly at the center of it all?
Oh, it's very, very real. The AI supercycle boils down to a simple fact. AI data centers consume an astonishing amount of electricity, and our current grid infrastructure was never built to handle that kind of load. So you need two things. You need more power generation, which, remember, we just covered with the power segment. And you need all the gear to connect that power to the data center. That means transformers, switchgear, and the sophisticated software to manage it all. That is precisely what the electrification segment does. And hey, don't just take my word for it. Look at what the CEO, Scott Strazek, said on the earnings call. He's growing his optimism about how material this is. They are leaning into this business, he said, because they are seeing hyperscalers like Amazon and Microsoft come to them directly to buy power equipment, completely bypassing the slow-moving utility companies. This is a fundamental shift in how this market works.
And here's the crucial point. This isn't just growth for the sake of growth. This is incredibly profitable growth. Just look at the margin expansion in this segment. In the fourth quarter of 2024, their EBITDA margin was 13%. Okay, respectable. A year later, it's 17.1%. That is a massive jump in profitability. It means they have pricing power and they're executing flawlessly. And they expect to maintain those strong margins in the first quarter of 2026. They're not just selling more gear, they are making significantly more profit on every single piece of gear they sell. This, my friends, is the very definition of a healthy, growing business.
All right, analyst, you've painted a beautiful picture, a true masterpiece of industrial strength. But I've been looking at these blueprints the whole time, and you've conveniently ignored the massive, undeniable crack running right through the middle of the whole thing, the part of the business that's a financial black hole. Let's stop avoiding it. Let's talk about the win problem.
Let's just start with the number. The one number that I guarantee spooked the market. Negative $400 million. That's not revenue. That's not profit. That is the projected EBITDA loss for the wind segment in 2026. So while power and electrification are printing billions of dollars in profit, this one segment is a financial black hole, projected to burn through nearly $500 million next year. You cannot just brush this aside. This is a significant drag on the entire company's profitability. It's an anchor tied to a speeding boat.
And when you really drill down into it, the picture actually gets even worse. They're guiding for organic revenue in this segment to decline by low double digits next year. At a time when the other businesses are booming, this one is actively shrinking. The CEO himself describes profitability as a work in progress. The entire industry is a minefield of high material costs, supply chain nightmares, and constant project delays. But here's the real kicker, the point that really matters to an investor. Their main competitors, like Vestas, have already found a way to be profitable in this exact same tough environment. So the question the market is asking is simple. What is their problem? Is it bad technology? Is it poor management? If they can't fix this, if this segment continues to burn cash and shrink, how much of the hard-earned profit from the good businesses will it consume? Could this one crack really compromise the entire structure?
And that right there, that is the billion-dollar question. We've inspected the strong parts of the foundation, and we've exposed the very clear weak point. So now we have to put it all together and render a verdict. When you weigh the incredible momentum in 2/3 of the business against this persistent drag from the other third, is GE Vernova a generational opportunity to invest in the global energy transition, or is it a classic value trap for investors who are ignoring some very obvious risks?
Let me just lay out the full bear case, the reason the stock dropped. It's built on these 5 pillars of concern. First up is valuation. The stock has had a meteoric run and it's priced for absolute perfection. It's trading more like NVIDIA than a company that makes 500-ton turbines. There is zero room for error at this price. Second, you've got execution risk. A $150 billion backlog is fantastic, but now you actually have to deliver it. Any major supply chain issue or project delay could be catastrophic for earnings. Third, that wind problem isn't going away. That negative $400 million loss is a real, tangible weight on the balance sheet. And finally, you have the standard macro pressures and intense competition from huge players like Siemens and Mitsubishi. The bears argued that the stock simply got way ahead of itself, and now the risk is heavily skewed to the downside.
All valid risks, I agree. But the counterargument, the bull case, is to simply look at what the people running the company are doing and saying. This timeline right here is management's vote of confidence in themselves. They just raised their 2026 revenue guidance to a range of $44 to $45 billion. They are increasing their free cash flow guidance to over $5 billion, and their long-term outlook to 2028 is even more bullish. They now expect revenue to hit at least $56 billion with a 20% adjusted EBITDA margin. Now, these are not the actions of a management team that is scared of execution risk or worried about the wind segment sinking the whole ship. They are telegraphing extreme confidence in their ability to perform.
So this is it. This is the final inspection. The bull case is clear, and it's powerful. You have a dominant player in the AI Power Supercycle. The power and electrification segments are high-margin cash machines, and a $150 billion backlog gives you years of visibility. You've got a disciplined leadership team that knows how to execute. But you absolutely cannot ignore the bear case. The valuation is priced for perfection, leaving zero room for any misstep. The wind segment is an anchor, burning cash with no clear end in sight. The execution risk on a backlog that size is absolutely massive. And the market sold the news for a reason. It's a sign that maybe, just maybe, the hype has finally peaked.
So where does Iron Financial land on this? After inspecting the entire blueprint, what we see is a structure with a core made of reinforced steel. The power and electrification segments are not just strong, they are accelerating, and they're being driven by a secular tailwind in the AI supercycle that has years and years to run. The crack in the foundation, that wind segment, it's real, and it is a problem. But, and this is the key, it's a known problem. That negative $400 million loss is not a surprise to anyone. It is fully baked into expectations. We believe the overwhelming strength and the highly profitable growth in the core of the business are more than enough to offset this weakness. The market sold the news, but the news was fundamentally fantastic. The ultimate question for you isn't whether this company is flawless, because it's not. The question is this architect's blueprint, with its incredible strengths and its one very visible flaw, strong enough to build a position in your portfolio? That's a decision only you can make. Thanks for watching Iron Financial.